Perfect. So perfect. All right. Hi, everybody. This is Adam Libman here with Jeff Field. Jeff is an estate planning lawyer. I've known Jeff now since 2014 or 13.
Yeah, I think so.
Wow.
Maybe
Just like it's been a while. I had more hair back then. Just to let you know, I've personally done business with Jeff. My parents have done business with Jeff. My friends have done business with Jeff. My clients. Jeff is just a really decent, good person. Even some of my clients who have different, I'll never forget, just give you there's a client of mine who has a different political bent than Jeff. And then originally this was actually a big turnoff for this client. And he's like, I don't like his politics, but God, he's such a good guy. He really knows what he's doing. And Jeff, you've been doing this for a long time. How long?
15 years.
Oh my God.
Yeah.
Wow. Well, that's a long time. So at least in my book. So anyway, the reason why I put this Zoom together is Prop 19 did pass. Most people have heard about it in the paper. They just don't know how it's going to apply to them personally and the negative impacts. I think we can all agree that funding schools is a good thing. I think we can all agree that healthcare is a good thing. And it's going to come out of your pocket, which might not be a good thing. So Jeff is going to talk today about how other people could pay for the well-being of California and not make it you. Is that a good setup, Jeff?
Yeah, perfect. Sounds great.
Perfect. So what I'm going to do, Jeff, is I'm going to see, and I'm learning this Zoom stuff, is I'm going to make you the host.
Okay.
But just be aware you're going to have to add people, if that's okay.
So how about this, before you make me the host? What if I can you allow me to share my screen?
Let's take a peek. Hold on. I'm sure there's a way. I can't figure it out in the next 5 minutes.
Okay. So I will try to keep an eye on adding people. So we'll try to do it at once.
Perfect. So I'm going to make you the host.
Okay.
And that will allow you to share your screen. And then what we'll do, so Jeff's going to present right now. And then after the presentation, we're going to open it up for questions from all of you for your specific questions. So is that a fair deal?
Sounds great.
Perfect.
So we'll go through this fairly quickly, just kind of give you an overview. So like it says, Prop 19 changed the rules for real property taxes. And transfers between parents and children will now be subject to reassessment with one exception, and we'll go over that. So let me start by just saying this. Your current property taxes will not be going up because of Prop 19. This is about passing on the property to your children, potentially your grandchildren. So this is not about an increase in your property taxes. So let's briefly talk about what Proposition 13 is. It established the current property tax law back in 1978. So we have 40 plus years of property tax law that has been upended. Propositions 58 and 193. Prop 58 established parent-child exclusion from reassessment in 1986. What that means is a parent could transfer their property to their child and their child keep the same tax bill. In 1996, grandchildren were included, and we'll talk about what are the requirements for grandchildren receiving property from their grandparents and keeping the same property tax base or property tax bill. So these are the two propositions that have been upended by 19. So generally my clients have a personal residence, a vacation home, and rental property. Prop 1558 at the time protected these properties from being reassessed when a transfer occurred between a parent and a child or a grandparent and a grandchildren. But Prop 19 brought us the big tax hike. So here's the formula. And again, we'll answer any details later, but this is the new formula for a primary residence if it's transferred after February 16th, 2021. What we do is we take the taxable assessed value, and you can find that on your property tax bill, and then we add $1 million to it. And that $1 million plus the assessed value is excluded from reassessment. However, if the excluded taxable value is greater than the fair market value, no tax increase. And I'll show you an example. If the excluded taxable value is less than market value on the real property, there is a property tax increase. So let's look at an example. So I have a primary residence. The assessed value is $150,000. We add the $1 million. So the total is 1.15 million. The market value of the home, the current market value of the home is 2.1 million. So it's greater than the excluded taxable value, which means that property taxes are going to be increased. And this is how it's calculated. We take the current market value of $2 million. We subtract the 1.15 million excluded value, and we have an added tax value of $900,000. So the current property tax bill is $2,000. The increase is 900,000 times 1.25% or 11,250. The new property tax bill for a child who inherits the primary residence will be $13,250. So that's how the property tax is calculated. And that's the main increase when it comes to the fair market value being greater than the excluded taxable value. Okay. So there is an exception though. I have to add somebody, sorry. And that's the primary residence exception. In order to get that taxable basis that we talked about on the last screen, your child must make your residence their primary residence. So let me repeat that. The only way you get that increase or no increase is your child has to make your primary residence their primary residence. Otherwise, that $2 million example I just used, if they kept your primary residence and didn't make it their primary residence, the full $2 million would be reassessed. And that would be about a $27,000 property tax bill. So again, Prop 58 is primary residence, vacation home, and rental property. Oh, we have somebody that we need to mute. Hold on. There we go.
Had to be my mom.
Your mom, okay. So Prop 58 and now Prop 19 totally took out vacation homes and rental property. So after February 16th, 2021, there is no exclusion from reassessment for vacation homes and rental property. They will be reassessed if your children decide to keep them after you pass it on to them. So transfer of vacation home or rental property to children after the 15th will result in a reassessment and higher property taxes. Again, Prop 58 actually protected those homes and residences. Now it doesn't under Prop 19. So let's talk about vacation homes and other rental property. And here's an example. So I have a vacation home, a rental property, duplex, and an apartment complex. When I look at the tax bill and I look at the assessed values, I have 100,000, 150,000, 250,000, 400,000. So it's $900,000 in assessed value, not market value, assessed value. And the current property tax is $9,000. Well, when we look at the current market value of, once this property is transferred to children, after you pass away or even after February 15th, what happens is the property taxes will be reassessed at 3.4 million and I need to move my screen so I can see it, or the property tax bill will jump to $34,000 a year. So I'm just going to let that sink in. What used to be, we could have protected this. We can protect this under Prop 58 right now. And as long as Prop 58 would have been in existence in the future, we would have been able to maintain the $9,000 property tax bill. Now, because of Prop 19, if your children decide to keep these rental properties and vacation home, their property tax basis will increase, and their new property tax bill will be about $34,000 on this example. So here's something we're going to walk through just to help you guys get, some basic information on, is this planning appropriate or not? So the first question is, do you have children? If the answer is no, you don't need to do anything. If the answer is yes, well, then the next question is, are your children going to keep your property after you pass away? And if it's no, you don't need to do anything. If it's going to be sold when you pass away, or you're going to sell it before that, then you don't need to do anything. But if it's yes, then the next question is, are you concerned, or are they concerned about the property taxes that will be reassessed at your death? If they're not, if they're okay paying more property taxes, you don't need to do anything. But if you are, then you want to preserve your current property tax bill for your children. And if you want to do that, if you don't want to, it's like, yeah, let them deal with it. No big deal. But if you do, then you need to call your estate tax lawyer or planning lawyer, or you can call our office to have a quick conversation about how we can go about this planning. So that in a nutshell is how we do it. Now, how do we go about doing this? So for primary residence and vacation homes, we create what we call a wealth preservation trust, and it's an irrevocable trust. It has to be drafted and funded before Prop 19 goes into effect, and we claim the parent-child exclusion. So that's how we deal with primary residence and vacation homes. With rental properties, we'll potentially use a combination of the wealth preservation trust and LLCs, because there's ways that we transfer property and continue to get income to the client using these two methods. And I know I'm going really quick, but I want to have time to have questions and answers, and I'm not going to get into the exact details of each of this, but we can have that conversation, or your estate planning attorney can have that conversation with you. So here's the issue. We have very limited time. It goes into effect February 16th. And the reality is everything has to be done by February 12th, because the recorder's office is not open on Saturday and Sunday, and February 15th is a national holiday. So we don't even have the 15th. So there are planning options available to preserve your parent-child exclusion. You have to transfer it into an irrevocable trust. And I have on here, we need to get this done by the 31st so that we can record it. I was talking to Adam. We could push it to February 5th, but we need that next week to make sure everything is recorded, because if it's not, game over. And that's it.
Cool. Well, thank you, Jeff. And you have the ability to, just for your purpose, you have the ability to help people today and the next couple of days.
Yeah. So let me give that again. So if you have more questions, you can call my office. If you don't have an estate planning attorney, that, I would call them first if you have one. If you don't, you can call my office, 818-369-7900, and my staff will set up a 10-minute phone call with me, and we can go over your specific situation. Again, I have to limit it to 10 minutes because I've literally probably had 100 of these phone calls since November 3rd.
Wow. Yeah. So why don't we do this, Jeff? If you wouldn't mind making me the host.
Okay, let me do that real quick.
And what I usually find is people care about their own questions more than what you just had to say.
Yeah.
So
No,
what I'd like to do is open this up to some of you who are on this call with your questions. So if you could just in the chat box, let me know who has a question. And then if you just want to unmute yourself, we'll go from there. So
All right, Adam, you are now the host.
Cool. So who has the question for Jeff? Someone has to be the first one to start. Hopefully my mom. People are shy. Am I just not seeing it? Let's see, who has a question for Jeff? All right, while people are summoning the courage, or maybe they're just in the background. So let's just say that you own.
I don't know, they need to unmute themselves. Did you say that already, Adam?
Yeah, just unmute yourself, yeah.
Okay. Oh, there's Bonnie.
Perfect. So Jeff, let's just say that you've got 5 rental properties and they're all under LLCs. You'd have to put that under another, or let's say the compliance costs for some of this stuff, like adding more LLCs. Is that disruptive, or does the math still pencil out?
For the clients that I've done that with, the math still pencils out, because what you have to look at is it's not just a one-time bill for property taxes. It goes on for the rest of the life of that property that you own it. So if I use that $34,000 a year example, that's $34,000 a year.
Gotcha.
Yeah. But I want to talk about something. If you already have property in LLCs that own real property, they do not qualify for the parent-child exclusion. So what we'd actually have to do is we'd have to transfer the real property back to the parents and put it in their name, transfer it to a trust, claim the parent-child exclusion, and then transfer it into a new LLC. So that, if you've already got property in LLCs and you want it to go forward, now, what we could do is we could look at the LLCs and see if they're structured properly. But LLCs that pass on more than 50% control at some future date, the entire property is subject to reassessment. So we have to unwind the LLC to get it back to able to use the parent-child exclusion.
And then I noticed you said something about an
We recently did that.
trust. What was that?
We recently did that for somebody.
Oh, wow. Wow. And this definitely involves the house goes into an irrevocable trust?
Correct.
And then usually that scares people, that idea of irrevocability.
Yeah, so let's talk about that. So with an irrevocable trust, what we do is we give the present benefit to that child, but the parents are still the trustee. So by being the trustee, you still control the property. We also make sure that there's a side agreement that says that, oh, the children can't kick you out of your home, otherwise there'll be a lawsuit. And if you think your children are going to kick you out of your home anyway, I wouldn't do this. So we have side agreements for that. And we explain the fact that as trustee, you can sell the home and buy a new home in the future. And there's certain things that you can do. So even though it's irrevocable, we put in some safeguards where you still have some aspect of control over it.
Got it. And then at that point, would you have to file a 1041 form?
So if it's just a vacation home, we make it what's called a grantor trust, not to get too geeky, but by making it a grantor trust, we can continue to use the grantor's same social security number. And so there would be no 1041. When it comes to rental property, we would have to get a tax ID number and we'd have to, report the 1041. But again, it's a grantor tax form. So as you know, Adam, that's just a letter saying, here's the net rent. And that 1041 is pretty straightforward. It's not complicated like other 1041s.
Okay, so this is from Darrell. Darrell, can you unmute yourself? Or if not, I'll just read the question. Darrell, can you unmute yourself? Ask to unmute.
I'm trying. Can you hear me?
Yes, I can. Hi, how are you? You're live.
Good. So my question was, if the survivor, if the child, if this is the primary residence, first of all, does this apply to the primary residence that the parent is living in?
Okay, so with the parent, is the parent still on title?
Yes.
Okay, so the parent, in order to preserve the property tax, the parent would have to transfer title to the child and claim the parent-child exclusion to avoid
Okay.
the primary. Now, after February 16th, is this your parent?
It's my parent, and my brother is on the title with my parent.
Okay, so now it just got complicated.
Yes.
Yeah. So that's where we have to look at the title. Is it in joint tenancy?
Yes.
Okay. So what happens with this is when your mom passes away, it automatically by operational law becomes your brother's property, 100%.
Okay.
But at that same time, and let's hope your mom passes away way beyond February 16th, 2021, your brother would be subject to reassessment and his property taxes would increase unless he's already is he making it his primary residence right now?
Yes.
So then he would have to continue to do that. And then we just go back to that formula, assessed value plus $1 million. If the market value is above $1 million, there's an increase. If the market value is below that $1 million plus assessment, no increase.
Got it. Thank you. And then my second question was, does this apply to all investment properties in all 50 states, primarily Hawaii? Or my
No, this is purely California.
Okay. Okay.
But as the saying goes, so goes the nation, as goes California. So it's only a matter of time.
Okay. Thank you.
You're welcome.
Perfect. And then I believe Anthony, if you're still listening, can you unmute yourself if you have a question? Either otherwise, I can try to.
Yes. Can you hear me?
Yes, Tony, Anthony from USC.
Yeah. So my question is, currently, if the parents gift the property to the child before death, does the child keep the original assessment? How about does that? And if so, if not, how does it change up under Prop 19?
Sure. So yeah, if your parents gift the property to you, not just before death, but before February 16th, 2021, and you file the right paperwork with the county assessor, the same property tax bill assessment will stay in place. So
how about after, under Prop 19?
Yeah, after February 16th, what will happen is the child has to make their parents' primary residence their primary residence. Then they take the assessed value plus $1 million. And if the market value of the home at the time of the transfer is less than the assessed value plus $1 million, no increase. If it's greater than $1 million plus assessed value, whatever the difference is assessed at 1.25%.
Great, thank you.
You're welcome.
Perfect. Any other questions? This is the time. This is your chance to get free information out of a lawyer. I mean, I had to give him some medication just to be on the call. All this free information. Who has a question? Free questions for Jeff? Jeff, we'll start here. What are some of the other questions that you commonly get asked that, like the questions like every person's going to ask you, like maybe we get all of those out of the way while people are thinking of questions?
Yeah. So, well, most of them are what, Anthony and Daryl asked. Those are the most questions. And that's why at the end, I asked the question, I go, well, do your children want to keep the property? That's a big one. Because if they don't want to keep the property and they're going to sell it, when you pass away, then you really don't need to do anything. And then other questions are like you asked, Adam, well, I don't want to put it into an irrevocable trust. That sounds scary. I'll lose control. Well, no, that's not true. We can set the irrevocable trust up where you still have control. You still have the right to live in the house. You still have the right to, to sell it and buy a new house in the future under the trust. So those things, we get those questions. And once we explain how that trust works, people are comfortable with it. When it comes to rental property, the big question is, well, I'm living off the rental income. How do I keep the rental income? And that's where we don't have enough time for me to explain that, but that's where LLCs come into play and promissory notes and all that. That's when it gets really complicated. Not that we can't do it, it just is a longer conversation. So that's one of the things. How do I keep my rental income? There's ways to do it, but there's a lot more legal work involved to do that sort of thing.
Got it. I'm thinking about a client of mine where father and son basically are, let's say like 50-50 partners in an LLC. And the guy is like, he's on his deathbed per se. Actually, I'm just going to probably call you after this one.
Okay. Yeah. So in that situation, we would want to look at the structure of everything. And in order to get the parent-child exclusion, we may have to unwind the LLC, or we may be able just to transfer the father's portion and avoid reassessment. But I would have to look at the document. So there's a couple of ways we could go on that situation. Here's another question that people ask all the time too. They go, okay, Jeff, great. I want to preserve Prop 19, but if I transfer it, what about a step up in basis for capital?
Yes. Yes.
So, what we do there is we draft the correct language into the trust so that the step up in basis is still available to the parent and to the child. Now, that property is included in their estate for estate tax purposes. So that would raise another question is, do they have an estate tax issue? Most people don't. At, what is it, $11.7 million this year that you can pass on estate tax free? So the big question for people is step up in basis. We put that language in the irrevocable trust so that that is still available to the estate and to the children, that they get that step up in basis and capital gains is wiped out. I have to put a caveat there. That's based upon current law. I know that the incoming administration, they're talking about changing all of that. So like I tell my clients, I can only plan based upon what's the law now. Nobody thought Prop 19 was going to ever become the law. So that's just part of the caveat. But right now, we can get the step up in basis.
Got it. Any other questions for Jeff while he's still available? Still available? How about Bonnie or Lilia or Gamer, Kevin, Kenny, Pepper, my mom, Dad? Maybe they're just in the background watching something else. Jeff, what's the best way for people to get a hold of you, and what's kind of the process going forward? Or just take people, so let's say they call you, what should they expect?
Yeah, so call me at 818-369-7900. We'll set up a 10-minute appointment, and then what we're going to do is we're going to ask you to go get your latest property tax bill so that you have the assessed value on those properties. We'll do a little bit of research on ours, so we're going to need addresses and all that when you make that appointment. And then we'll be able to take 10, 15 minutes and go through your particular situation and actually calculate what's the new property tax if there is one. So call, make a 10, 15-minute appointment. Make sure you have your property tax bill when you come to that appointment.
Gotcha. And then let's just say they're like, Jeff, I like you, but I already got a guy. I already got a girl.
Yeah. Call that guy, call that girl.
So tell me what would you recommend? Just
well, so here's the thing. So I would say call your estate planning attorney. What I've discovered is a lot of estate planning attorneys don't understand what's going on with this and don't know how to address it. In fact, I have a meeting today where a client's estate planning attorney said, yeah, Jeff, I don't know how to do this, so I'm turning the client over to you. Yeah, so I would inquire with your estate planning attorney and see if they're capable of doing this. If they're not, or they have questions and they go, I can't answer those questions, then by all means, you can call us. I'm happy to help people avoid a property tax increase if they don't want it.
Gotcha. And probably the next thing I've noticed, at least even for myself or my parents, is the hardest thing that I've noticed for most people isn't dealing with death or mortality. It's like, who do I want to give something to? This cousin's an asshole. This guy's a dick. This guy owes me money. What happens if I have grandkids? And I think indecision kind of is the issue that stops people from moving forward. So I just want to be clear on this. This is something that you can kind of remedy the immediate problem, and all the other outstanding issues can be
Addressed
later.
Yeah, it can be addressed later. Yes.
But something's better than nothing, right?
Correct. Yeah, absolutely. So somebody has some questions. Anthony said, if you gift before death, does one lose a step-up basis? Anthony, it depends on how you gift. If you just do a deed and you transfer it, like your parents prepare a deed and they transfer it directly to you, yes, you lose the step-up in basis at their death because you inherit their basis based upon that deed. That's why using the trust preserves the step-up in basis. Without the trust, you lose the step-up in basis.
And then I think there's another for Bonnie. Oh, Dallas. So that Dallas is a whole other. So this, to be very clear for everyone, this is a California issue today. But as Jeff mentioned, other states are broke too.
Yes.
Yes. Any last parting words or any last questions? We'll do like an auction style. Or Jeff, any last parting words?
The only thing with Bonnie is she lives in Dallas, Texas. Just to clarify, Bonnie, if you have any California real estate, that's the planning you would want to do is for California real estate, not Texas real estate. It has nothing to do with Texas.
Gotcha. Perfect. All right, so we're going to do auction style. Any last questions for Jeff? Any last ones? Wow. All right. Well, thank you, Jeff. I sincerely appreciate you coming on. This recording will be made available for everybody. What I'm going to do, Jeff, on my side is all the clients who I think this applies to, I'll send the link to. And
just so you know, Adam, too, if you want, I think we sent it to you, but I have, a 30-minute YouTube video I did that doesn't run through it as quickly as I just did. So if you've got clients that you think would be important to, you can share that YouTube video with them as well. Just for sake of time today, I did it quick because I wanted to get to people's questions and all of that, as you and I had discussed.
Yeah, perfect. And then one last point, if any of you have this issue with yourself or for your parent or grandparent, time is of the essence. What's happening is, and Jeff, maybe we can just play with, get to the scarcity play on this one, but normally times there's a lot of fake scarcity out there. This time it happens to be real because these things take time. There's a little bit of planning. There's a little bit of research on your side. Like you have to do a little bit of work, not too much work, a little bit of work. Yes. And then lawyers have to get involved and you have to go to the county recorder. So there is literally work and time involved. So if you're thinking about this, trying to make a decision quick, that would be a fair statement.
Yes, absolutely. Yeah, time definitely is of the essence because we will run out of time and will not be able to do this.
Thank you so much, Jeff. I think I'm going to end the meeting for everybody now. I think this is really a lot of fun. Thank you. Hopefully we'll be able to have you on later for other related problems that I know will come up. So cool. Thank you, guys. I'm going to end the meeting now, and we're going to go from there. Take care, everybody.